All right, today is Tuesday, September 1st. We're starting fresh. It's a whole new month. And of course, this is a post market review for the stock market activities today. Here is the agenda of the day. We will cover the closing of the market, the sector's performance, the futures performance, the options market performance, the headlines of the day, and then we will talk about an important subject of how the greatest investor of all time, Warren Buffett, weathered the storm of the tech bubble in 1999. There are important lessons that we can learn from that example and what we're going through right now in 2020. Then we'll move on to cover the charts. We're covering today the SPY, the Triple Q, the VIX, and a weekly chart of Apple. And then, of course, we're moving to the heat map analysis and an update on the vaccine rotation trade. And then, of course, we will conclude the video with an important message to take. So here we go. The Dow Industrial Average closing in the green, up 215.61 points or 0.76%. The Nasdaq leading the day. What is new? We're back in 1999 again, up 164.21 points or an increase of 1.39%. The S&P 500 closing in the green, up 26.34 points or 0.75%. And here is the sector performance. Leading the day, of course, tech, followed by materials. And of course, I love materials because I do have gold and copper due to my ownership in Freeport McMoRan. Although copper was actually down. The actual copper was down. We'll cover that in a little bit. But the third place and the bronze medal goes to communication services. And the laggards leading the decline, healthcare, utilities, and energy. And shifting to the futures market performance, leading the day, oats. You see oats continuing to climb. We started a position in oats yesterday with a big day. Today is another big green day. And of course, the beauty of the futures market is you don't have the Robin Hoodian gamblers who are roaring the market for you. So the market is technically sound. And of course, we have lean hogs increasing today. Platinum, palladium in metals, of course, catching a bit. And coffee, what do you know? The climb continue. We missed that one. And coffee keeps going on and on. And what about wheat? Big day for wheat today. Meanwhile, decliners, copper down just by a little bit. OJ's declining. Back to the 115 level support that we've identified before. We will see if it is going to hold or not. Natural gas and rough rice declining today. And now, moving on to the big casino, the gambler's market, the options market. Let's see how hot the tables were today. As you can see, massive volume in the options market today, specifically in the top two names that split recently, Apple and Tesla. Apple leading the day, 3 million options traded today, 72% of them are calls. So the bets and the mania are to the upside again. And coming up in the second place, Tesla, 1.6 million options traded today, 65% of the volume were for calls. And number 3, of course, Walmart with 740,000 options traded today, 88% of those are calls. And check out Zoom. Zoom zoomed upward today, over 40%. Yet the gambling market says there's a 50% chance it will continue to rally in the days to come, at least for this week. 50% of the options traded today for Zoom are for calls, and the volume was about 400,000. And check out this name, Qualcomm, catching a bit in the gamblers market with 89% of the options traded are calls. This is deja vu. We're back in 1999 exactly. And the market, the stock market that is, becoming very dangerous place to be because it's not led by organic buying of stocks, meaning that the stock market is moving solely based on the action of the options market. The gamblers have taken control of the market and they're leading it impulsively higher and higher every day, not by buying stocks directly, but by betting on their derivatives options. This is a very risky environment because these gamblers, if you can take a look at the volume of Apple, 3 million options traded today alone. The majority of those are calls expiring this week, at the end of the week. The risk here that any shock to these positions, and these gamblers will do impulsive moves and drive the stock market significantly higher or lower. So again, the market's becoming very, very dangerous when gamblers take the driver seat. And now, moving on to the headlines that shaped the day. And the first headline, of course, came from overseas. Overnight, from Japan. Japan's second quarter CapEx, capital expenditure, declined the most in a decade. This is another sign of global slowing economic activities. Bear in mind that Japan did everything in the book to manipulate the yield curve and to push inflation higher to stimulate their economy. And it's not going good so far. Yet our central bank, the Fed, wants to follow the Japanese example. So they better be careful here because it did not work for Japan. It worked for a little bit, but it's not working so far right now. And here's a headline from our market, our employment picture. Ford firing over 1,000 paying jobs. And of course, we heard the news today that 14% of Americans have exhausted their emergency savings. They don't have savings anymore. They had emergency savings, and now those savings are drained. We're seeing more holes being poked in the V-shaped recovery picture because consumer purchasing power is being dwindled by all of these layoffs and drainage in consumers' savings. And let's check on the market mania and the bubble. What's going on with the stampede? Here is a headline from Bloomberg, and the media is starting to catch up to what's going on in the market. They're calling the conditions that are going on in the market right now as a euphoric land, not seen since the dot-com era. This is what we've been saying here in this channel for a while now, and you're hearing that the media is starting to pick up on it. And we know the counter argument. The Fed wasn't there in 2000. We have the Fed now. You're right, but trust me, the Fed would love to see a correction and a big crash in the market, and then they'll interfere to rescue it because they're gonna buy assets cheaper. The Federal Reserve of the United States of America has turned into a private equity firm, and they would love to see a discount in the market. The question is, will you survive after that discount happened, or did you throw all your portfolio into a weekly call just like the gamblers are doing and you lost it all? That is the most important question here. And moving on, here we go. Apple says iPhone sales will not be affected due to the pandemic or the rise of unemployment. I'm assuming, of course, that the Federal Reserve is going to buy all these iPhones with the fake money. That is the only reason why iPhone sales will not be affected by the pandemic and the unemployment. And nothing illustrates the bubble and the mania better than Tesla stock. Perhaps the biggest bubble in our lifetime. Here it is illustrated. Tesla market cap is now bigger than Mickelson, Costco, Boeing, CVS, Ford, General Motors, and Kroger combined. Mind you that these companies generated over 1.1 trillion bucks of revenue last year. On the other hand, Tesla, the company that is worth more than these companies combined, generated only 24.6 billion bucks in revenue last year. Enough said. And here we go. Apple stock is 24 bucks away from being worth more than the entire nominal GDP of the United Kingdom. Apple is bigger than Britain, the entire country. How do you like that for rational and a reasonable market? Pretty soon, Apple would be worth more than the entire United States of America. And of course, here's a tweet illustrating that Apple, the last 2 days since Monday, added to its market cap what is worth an entire company of ExxonMobil. Apple created in 2 days an entire company worth Exxon Mobil out of thin air. This is the power of the mania and the gambling when the stock market becomes a video game. That gamblers are betting left and right, buying calls, weekly calls, and they're pushing the stocks higher. This is what happens. But for your own sanity, we will visit what happened in the dot-com era with Warren Buffett. If you remember, Warren Buffett was very skeptical about the entire tech rally and the dot-com rally in 1999. He did not trust it. He missed out on it, and he kept buying boring names, and he underperformed the market. And he was a subject of mockery of the dot-com bros who became instant millionaires betting on speculative stocks at the time, and I will show you how that ended. I released a series of tweets. I'm going to read it for you, quoting specific articles and quotes from the years 1999, 2000, and 2001. So here it is. At the height of the dot-com bubble in January 2000, Warren Buffett was mocked for missing out on the impulsive tech rally. The 69 years old Buffett was called too old and running out of favor. 2 months later, of this specific article where they called Warren Buffett out of favor, the tech bubble bursted. Meanwhile, Warren Buffett is still here and he outlasted all of these donkeys. Continuing, here is an article from the year 2000 suggesting that you should ride the tech bull market and invest in the high flying names regardless of valuations. Analysts or market participants continued to pile into tech stocks in 2000, even after being aware of stretched valuations, arguing to quote-unquote follow the trend. Sounds familiar to you? Are you hearing that today? Buffett disagreed, saying that tech stock or the tech stock market is behaving in ways not linked to value. Continuing, fast forward to 2001, and we're linking this to an article from the BBC. The dot-com bros who enjoyed the mania and became millionaires overnight have now lost it all and faced the reality of life, realizing that there is no easy way to get rich and that all they did is investing in a lottery ticket. Continuing, after being mocked and doubted in the short term, Buffett had the last laugh. And Berkshire Hathaway, which underperformed the Nasdaq and the speculative tech stocks and the tech mania, have now reversed course after the Nasdaq crash and outperformed the Nasdaq for years to come. Warren Buffett outlasted amateur investors who struck luck overnight and never knew how to keep it because the discipline is not there. When you are in the bubble, in the heat of the bubble, you have a tunnel vision. You think that stocks are going to go up forever. You forget the most important rule of investing. Take profits. Hit the sell button once in a while and book your profits. No. You're not going to do that because you're waiting for the stock that went 20% yesterday to go another 20% today and on until, of course, the big flush down, the crash that catches you by surprise, and now you become resentful and you think it's a dip worth buying. You buy the dip, you bury yourself deeper in the hole, and of course, by the end of it, you realize it was a crash, the party's over, and now you lost it all. You had a few months of euphoria and an adrenaline rush, and now it's all gone. And by the way, here are the top stocks that performed in the year 1999. These numbers are percentage points. See for yourself and take a minute. Pause the screen and try to see if you can realize or recognize some of these names and guess what their fate ended up to be. And now, moving on to the charts analysis, starting with a daily chart of the SPY, the S&P 500. We are now making this wedgish trend in the current leg of the rally. These wedges for technical analysts are usually bearish because they lead at the end of the wedge to a break down from the trend. I don't put a lot of stock in these things, but I take them in consideration, and I'm presenting the view of technical analysts to keep in mind. Anyhow, we do have an overextension in the market that has to at least cool down for a little bit. And you can see in the RSI, the daily RSI and the SPY, we've already reached the high territories where we've corrected from before. And when we switch to the triple Qs, a daily chart, you can see the divergence from the trend line that started since April is now at the highest point since the trend started. We're diverging by over 10%. It is very unhealthy, and the higher we diverge, the faster and the steeper the revisit to the trend line would be, and the higher the probability that we will pierce through the trend line. And when we take a look at the chart of the VIX, here's a daily chart of the VIX. The VIX is rallying again today. The VIX doesn't care. Tech stocks, Dow, SPY, it doesn't matter. They can rally all they want. The VIX is going to rally as well, because the VIX is trying to send a message here to the overall market. Some will listen to that message, but most won't and will be caught by surprise when the content of the message takes place in the market. And when we take a look at the weekly chart of the VIX, here you can see that the crossing of the MACD, crossing the average and making green impressions, is now imminent. It could happen as soon as tomorrow. And if we do that, we're unleashing the genie out of the bottle. And once the genie is unleashed out of the bottle, he's not going back in until he does the job. And the job is to correct the market. So keep an eye on that one. We're of course not going to cover gold, the dollar, or the TNX because there are no important updates in these charts since the last time we discussed them. However, let's take a look at Apple's chart from a weekly perspective. If you've been a follower of mine, you know that I have an RSI threshold. And I said, once we reach that RSI threshold, I will be ready to short Apple again, because this level of the RSI, which is 85.64, is the highest or the second highest that Apple reached in its entire movement since it became a stock. Anytime it reached anywhere closer to that level, it had a massive correction to the downside. Where is Apple now? It is at 86.98. It is far ahead of this threshold. So we have to be extremely, extremely careful. You know that this market is not going to make it easy for you. It's going to trick you, and its job is to flush the weak hands. The market's job is to show market participants how market Darwinism works. What is market Darwinism? It is survival for the most disciplined and fit. Those are traders that are not chasing the hot moves day by day. They're not seduced by daily moves, impulsive moves. They have a strategy in the market, a long-term strategy. Those are the traders who are going to survive. The gamblers will be flushed out. And what a perfect week for the market to flush out the weak hands. You know why? Because the market gave you a trap Monday and today, Tuesday. You saw the options volume exploding in calls. These are weekly calls expiring by the end of this week. Millions of options are being bought for this week's expiration. So what they do is they suck you in. They give you 2 hot days. Everybody buys calls. And what do you know? By the end of the week, they flush the market down and all these options expire worthless. And you see massive wealth from traders disappear. They spent the last 2 months or 3 months building it and they lose it in 1 week. I'm not saying this is going to be that week, but this is how it's going to happen. They will give you a few good days, hot days, Monday, Tuesday, perhaps Wednesday, sucking everybody to buy weekly calls and then flushing them all out by the end of the week. We've seen this movie before. It will happen again. And now moving on to the heat map analysis. Let's see what we can dissect from the heat map and if there are any important messages to pay attention to. Right away, the market breadth is a little better today than yesterday, but again, we're being led by the big boxes of Apple, Amazon, Baba, the software names, the impulsive software names, Nvidia, and we only see a day or two where laggards rally. This is not a healthy trend. And of course, you see Zoom. I'm pointing at Zoom right now. Zoom up 40%, more than 40% today. And of course, I've been watching CNBC throughout the day just to hear what they're going to say about Zoom. And the analysts coming out saying, yeah, it's kind of overvalued, but you don't want to sell it now. Perhaps you want to buy it And they're giving all these justifications of how Zoom is worth what? Over $100 billion now. We understand it's a good company, it's an excellent product. Everybody's using it now in the pandemic environment. They've expanded worldwide, not just in the US, everywhere. People are using Zoom. The question is, we have now overpriced the story. We're pricing in 10 years worth of gains already. And any unpleasant surprise in the name, whether it's the development of the vaccine, the announcement of the vaccine, or any serious competitor product, the risk will be a big flush to the downside. The risk versus reward here is not worth it to keep and buy the stock. That is insanity at these levels. Zoom, of course, we saw executives selling their Zoom shares starting last month, but Zoom is now in the Facebook dilemma. They have billions of users that they've acquired during the pandemic. The question here, how can they keep them, at least the majority of them, and how can they monetize those users? Facebook figured out that problem. And you see Facebook as one of the most profitable companies in the world. Would Zoom repeat the success of Facebook? We still don't know that. We still don't know the picture of competition. You know that the richest man in India is working on a Zoom competitor for India. A lot of companies are ramping up the competition. More competition will suppress down margins. The businesses will not become profitable and generating big revenues as they used to. And needless to say, the product could be easily disrupted. So this is a very dangerous stock to be right now. However, the mania continues. Personally, I wouldn't buy it, but I wouldn't bet against it either. I would not short it because you could get stomped to death by the zombie trader stampeding to buy this name. So be careful here. And just watch the show. And take a look at this, the top right corner of the screen. What is that tech stock? Oh, it's Walmart. Walmart is being traded today as a tech stock, up 3, 4, 5% every day. All they had to do is announce an interest in buying TikTok, and the Robin Hoodiots and the zombie traders are now chasing the name aggressively. Whether they end up buying TikTok or not, who cares? They caught the attention of the zombie traders, and now they're catching a major bid. And now let's shift to the rotation trade. This is the vaccine rotation trade. For new followers, these are names that I went through in a previous video answering the question, what if we have a vaccine announcement before the elections here in the US? What names would benefit the most? What names you should start buying and nibble on little by little, switching from the high-flying tech names and the names that benefited from the pandemic situation to the names that lagged. And I will make another video explaining everything in details. But this is related to the vaccine rotation trade. The high-flying name, of course, outperformed today, mostly the tech names. However, the comeback stocks, as I call them, the laggards, did not do bad. Some were muted or down just by a little bit. Others actually managed to close in the green. So there is no rotation out of the rotation. The big investment firms are still rotating from winners to losers. That is still intact. What you have, of course, is the influx of new traders buying the hot names on your left-hand side. And that is, of course, causing the impulsive movements that you can see on the screen. But the rotation is still intact. And any dip on the names on your right-hand side would be an opportunity to buy. But remember, don't go all in. Nibble smaller positions at a time, just in case we have an overall correction in the stock market that would hit all names equally. And of course, notice that I did a good job in picking these names. For example, you see MGM closing in the green today, yet Las Vegas Sands and Wynn closing in the red. So I went in a previous video, and I can add the link in the description of this video to that video. I went in details thoroughly, picking up the names that you see in your right hand side. And of course, I did work and spend a lot of years working as a financial analyst in the Las Vegas casino industry. So this is my bread and butter, and I know that MGM is the name to buy here if you want to make a vaccine bet in the casino industry. And now moving on to conclude the video. This has become a video game market. It is no longer a rational market or an investable market anymore. You see impulsive moves with amateur traders who know nothing about valuations whatsoever, chasing and pushing certain names higher every day, looking at stock prices as if somehow it is some score in a video game, not an actual price tied to a valuation. We've seen this period before in the market many times, and the best thing you can do here is stay in the sidelines and watch the show. Because if you are tempted to jump in and join the rally, your timing could be bad. The bulk of the movement already happened. We are at the last third of the movement, a very impulsive movement where a lot of traders get seduced, they switch sides or they hop in from the sidelines, joining the rally, and the moment they join the rally, what do you know, the market reverses and they end up losing their money. Or they have a good streak of luck for a couple of days or a couple of weeks, and then they wake up someday, the futures are down big, something happened in China, and these names flush down severely, and now you lose all your gains and you're in the red. Very risky and very dangerous. You're looking at the forbidden apple right now if you're staying on the sideline. Literally, the forbidden apple. You jump and buy Apple stock right now, it is very dangerous and very risky. You could get hurt if things don't go your way. On the other side, don't be impulsive and start shorting the market and some of these names right now, because you will get hurt as well if the market continues to have an impulsive rally for a few days or a few weeks. Things could go against your way and you get hurt. Case in point, learn from my mistakes. Even though I have experience in the market, I've been trading since I was 18 years old and I worked as a professional in this field. I still do amateur mistakes when I don't listen to my inner voice. Case in point, a few days ago, I shorted DocuSign. What do you know? Today, DocuSign is rallying over 22%. What do you think happened to that position? It is scrambled eggs right now. Luckily, I only shorted 25 shares, which is a very small position. So the loss is very small in the overall picture. But what if you went impulsively and you shorted 1,000 shares or 10,000 shares of DocuSign and you jumped the gun? Now your losses become severe. This is why I say nibble. Nibble on positions and be very careful and very disciplined. The best way and the best thing you can do right now in this insane market environment is to sit in the sidelines, grab a big bag of popcorn, and watch the show. The market will break. There will be a lot of meat on the bone for you to short and make money from the movement and the crash to the downside. And there will be a lot of meat on the bone after the crash when the market reverses and recover to hop in the long side and capture gains at more reasonable valuations. And I will finish by mentioning this story from today just to show you where market sentiment is. I worked in capital management and I have contacts with former colleagues. I call them and chat with them from time to time to see what they're doing, because that gives me a lot of hints on what the big guys are doing in the market so I can follow some of their leads. The particular person I talked with today is one of the top traders in a very big firm here in San Diego. He manages over $400 million worth of investments. And he's getting calls from clients asking him, why didn't he buy Tesla or Zoom or Apple right now? Why didn't he add to their position in Apple after this big impulsive move? They're asking him to buy Tesla now, to buy Zoom now, to buy Apple now, and Nvidia, because they keep hearing about these stocks going up and up every day and they have the fear of missing out. So he's asking me, what should I do here? Ethically, I can't do that. I cannot buy Tesla and Nvidia and all these stocks at these valuations. These people are going to lose their money. And of course, I suggested that he reminds them of the dot-com bubble in 1999, because this is a déjà vu. Chasing the hot names might work for the short period of time, but it will not work long term. There is a correction. It will happen. Nobody knows when, but it is becoming more imminent by the day, and you will have a better opportunity to buy these names. So again, I told this guy, hey, if they want you to buy Tesla and Zoom and Apple right now, make them sign another waiver. So when they lose money, it will be on them. They cannot stain and tarnish your reputation. But it is a sign and a signal of the market mania and where the sentiment is. When grandmas and grandpas who are already on retirement and they need every penny they have calling you and suggesting they buy Tesla now and Zoom, we've reached a level of insanity very similar to 1999. And you gotta be careful or you're not gonna last in this market. You're not gonna make a career being an investor and a trader. Learn from Warren Buffett, the discipline that he had, taking the red pill but lasting for years and years. The gamblers who took the blue pill and chased the hot names, unless they were lucky and disciplined enough to hit the sell button and take their gains, they've lost it all and they went back and moved on to another career. Be disciplined, just like the greatest investor of all time, Warren Buffett. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.